All right. Looks like we're at time, so let's go ahead and get started. My name is Chinda Chun, and I'm with NACV and the Consultants Training Institute. I want to welcome you to the December 8th edition of the Around the Valuation World International Webcast. Before we get started with the show today, I want to go over a few housekeeping items. Let's see. So first, to obtain CPE credit, you must answer all the poll questions that pop up on your screen during today's webcast. If you have an AVW International subscription, you'll see the CPE certificates within 7 to 10 business days after today's webcast. If you have any questions during the webcast today, please feel free to use the Q&A feature, as those will be directed to us. If you have any questions about any CBA or technical questions about Zoom or anything, you can reach me at contact me through the chat feature as well. With questions, we're going to save those until the end of the show, and then Sarah can address any questions you may have at that time. With Around the Valuation World and Around the Valuation International, we try to cover all the hot topics that are coming up in the industry. With the 1 hour that we have here and the 2 hours in the other ABW show, it's not enough time to cover all the topics that come up. So there are some links in your material to different articles and publications, so you can stay abreast to all the changes that are taking place in the industry, all the updates and stuff. And today we have Wolfgang Nies, who is one of our editors today, who will be introducing our presenter, and then Brand Joseph advisor, and again, me, I'm the producer of the show. And so today we have Sarah von Helfenstein joining us with Moving Beyond Standard Practice, a new look at the discount for lack of marketability. So we're excited to have her join us today. Before we get started with that presentation, just want to go over a few items as well. With Around the Valuation, we have the AVW in-depth webinar series, where in our other AVW program, we'd have 15 to 20-minute interviews with everyone. But we wanted to elaborate on some of those topics. So there are some additional topics that are coming up. So if you are interested in those topics, there is a QR code. You can scan that QR code, or you can visit us at nacva.com/AVW in-depth for more information and to register for those. We also have our AI resources and webinar series that happens. It's one of we're trying to keep everybody abreast on all the topics with AI and coming up. So for more information about that and the AI bootcamp that's coming up, or there's some information in your material as well with links. So hope you're able to join us for those. And with that, I'm going to turn it over to Wolfgang, who will get us started with the presentation today.
Yeah, thank you, Chanda, and thank you, Sarah, for joining us today. Since December 1994, Sarah has specialized in business valuation. Prior to joining Dean Dorton, she served as a practitioner professional in her own firm and in several public accounting firms as well. Her valuation career began developing and managing national valuation educational programs for AICPA and the American Society of Appraisers. During these years, Sarah also participated in leading and mentoring tech startups. Starting her career as CFO and member of the founding team of a boutique consulting firm offering wealth planning and management and trust services for high net worth individuals. Sarah's expertise includes the valuation of business enterprises, business interests, intangible assets for operating companies, ESOPs, and holding companies in all stages of the life cycle. She's also editor and an author of the very highly recommended book, The Art of Valuation, published in 2023 by the Appraisal Foundation. Sarah has published and presented extensively in the US and internationally, and she has authored and edited valuation courses and examines, developed valuation curricula and conferences, and added lots of valuation texts. And having that we are looking forward on a new, fresh look at the DLOM, moving beyond standard practice. Yeah, having said this, I hand over to Sarah and looking forward to your thoughts, your HI thoughts, not AI, not AI, HI thoughts on D-Loan.
Thank you. Thank you very much. Let me share screen here. So I want
Perfect.
to start. Can we see my screen all right, Wolfgang?
Yes, yes, we can.
Thank you. Okay, thank you. I want to start off with Chris Mercer's challenge that actually was provided through NACVA in 2023 to us. He says, in the author's opinion, many business valuators have been reluctant to move beyond past practices. Something is missing from this traditional view towards valuation. The old way of doing marketability discounts, including the use of restricted stock and IPO studies and the minority discount, will fade from the discipline. Chris has always been on the cutting edge of this profession ever since I've known of him. He's written some exciting books, and I think I want to take his challenge seriously and begin to take you through another look at our discount for lack of marketability. Here's our page, our first page. We were asked to list some papers. I did publish a couple of papers about the OPM and the DLOM in 2017, and I have a paper of the title of this speech currently under review for publication. What will you expect from this presentation? Well, first I want to introduce you to what I call the DLOL-M. I want to show you its foundations in and challenges to many familiar concepts and data, and give you a flavor of the mechanics of and the rationale behind how it's built. What we're not going to do, because of the time that we have, the limited time we have to go through this, we're not going to be going through the shortcomings of other methods. These have been written about extensively. We're actually not going to present a full case study, although one is available if you would like it. Instead, we're going to use a highly simplified sample company to use to show how the mechanics of the process work. I thought it would be more informative for you to see the practical day-to-day use of this thing as opposed to going through a lot of theory. I want to start out with one of my personal crusades, and that is to praise the use of expertise. We normally call that informed professional judgment. However, it's fallen into disfavor. And I began to ask myself why, because of course, what we're really being paid for is informed professional judgment. But these are some of the reasons. And one of the reasons that I would like to do some refuting is this idea of creating an impression of science and precision in our work product, because what we do cannot be presented in a scientific and precise way. We're talking about ranges. Happens that there are other fields that use ranges too, statistics being one of them. And there's a large literature that supports the use of informed professional judgment. I took two specific papers, one from 2003, one from 2017, to throw some thoughts in your direction. Wilcox, King, and Zeithmal have indicated that experts create valuable knowledge resources, but these may not be accessible using quantitative, content-free approaches. Something to think about, because we often think we're making ourselves more accessible by wringing out informed professional judgment, but we may not actually be able to get to what we're doing with a strictly precise quantitative approach. This is not saying that I'm advocating for lack of rigor, but I am saying that there is more flexibility around what we do. Grunman then describes the difference between scientific activity and the kind of expertise that we use. And I think it was very helpful. He talks about scientists generating new knowledge within a context of the absence of urgency and with limited or no impetus for action. And that certainly is not us. We have an always urgency about what we do. We have an action-oriented focus. We define and interpret situations. We set action priorities and things of that sort. So to start out with, I want to praise what we can do so well, and use it as the basis for the type of things I'm going to be talking about. When I went about this research, which has gone on for quite a while, I asked myself 5 questions. And I believe that if you're going to challenge something that's used as standard practice, you need to get to the very bottom, the very fundamental things that make something be what it is. And so these are the questions I asked myself and the answers I gave myself after reading and thinking, and I'm going to present them to you for your thoughts. And these will provide the basis for the DLOL-M. First of all, does standard valuation practice define the DLOM correctly? My answer to that is no. And I show you below the 2 definitions that are in the International Valuation Glossary. They're virtually identical, and I've altered them slightly, as you can see in the blue, to show the actual differences between the 2. We've got liquidity, the ability to quickly or readily convert an asset, business, or investment to cash at a minimum cost and no loss in value. And the focus here is quickly and readily. In marketability, we have a different focus. And that is we want to convert the asset to cash at a cost that reflects the capability and ease of transfer or the saleability of that property. And so to enrich this idea, Pratt in his Valuing a Business 6th edition states, and I love this statement, marketability is affected by, among other things, the particular market in which the asset is expected to transact and the characteristics of the asset. We're going to use his statement to dig further. There's a little beef I have to take with the standard definition of the DLOM as an opportunity cost. I actually think it's not. And this slide gives a bit of discussion regarding what an opportunity cost actually is versus what the DLOM represents. I'm not going to linger on it, but it's there for your thought. So I'm going to propose that the lack of marketability should be defined as a form of asset transaction risk, of which the DLOL-M is the risk premium. This risk premium is composed of 3 risk factors. There's a market-facing risk, and here's some examples of that, which are familiar to us. There's a desirability risk. How desirable are the company and its securities to market participants? And then there's a time period risk. Does the lack of marketability exist over the foreseeable future, that is the perpetuity, or does it exist over a limited and defined future? We're going to explore all of this further. Just again, another little thought for your thinking. Often people worry about the DLOM as being somewhat the same thing as the company-specific risk premium, and there are reasons for Mandelbaum to think that. And on this slide, I give you some reasons to segregate the 2 and see that they're not alike each other at all. For instance, the DLOL-M, and that's the DLOM enhanced a little bit by some of the techniques that I'm going to show you, describes the subject's theoretical or anticipated transaction potential after it has been valued and after it enters the relevant market. So it's a different thing than the CSRP. Second question I asked myself, which market To which market does the D-Law refer? Normally, the answer to the next questions that I asked myself would be publicly traded. But as I began my research, I realized that there are many viable markets now, and new ones are coming online. And these are even being tracked in places like Yahoo Finance. For instance, there are 35 alternate trading system platforms for public equities and 54 for private equities, bonds, alternative investments. And there are 16 exchanges that are not the exchanges we normally use for data. And believe it or not, these platforms and exchanges generate a lot of data that you can put your hands on. You may have to buy some of it's for free, but there's a ton of data out here for different levels of things and different types of things than we normally use when we go to the typical, NASDAQ or New York Stock Exchange. Another thing that's interesting for your thought process is that there's a significant shift underway in the public markets. And the line is blurring between public and private markets. Morgan Stanley and State Street estimate that they're going to have private market funds that will reach 13 trillion assets under management by 2025, which is this year. So we propose that you begin to consider and use data available from some of these markets. And here are a couple of them for your consideration. Forge Private Market is listed actually in Yahoo Finance. EquityZen is not, but you can go out to that website and get a lot of information on private companies that are not pure startups. These are companies that actually are viable operating companies doing interesting things. Next question, digging down, which market participant perspective should our DLOM reflect? Well, again, we typically use the public market to get participant trends, but shockingly, and this is as of 2020, which is dated at this point, 80% of the capital that's allocated to investment funds goes to only 3 entities: Vanguard, BlackRock, and State Street, and these 3 cast more than 40% of the S&P 500 company votes. So what you're getting here is in the typical market participant outlook from the public markets, you're getting the investment outlook of 3 entities, and it's something to think about. The other thing to think about is that if you're using OPMs, the universe of option traders and their perspectives are not remotely like that of the owners of public companies or private companies. So they may not match. And I'm proposing that we use the wealth of literature available from the big fours. They're constantly generating really interesting papers, and from middle market associations and others like Business Broker Association, to get a sense of what actual market participant perspectives are in the markets where a subject might trade. Question 4, which public market data are appropriate benchmarks for the DLOM? The usual answer, publicly traded security data, particularly from restricted stock studies. Yet, as we know, restricted stock studies have been done for almost 60 years, and it's still not clear which part of the discount that they provide can be attributed to lack of marketability and which to other factors. So I want you to consider this about restricted stock, because I'm going to propose a change in our perspective and still use it, but have a different perspective on it. The equity underlying the restricted stock is publicly traded. It has a market established price. It's marketable. By extension, restricted stock is also marketable, though it cannot be traded quickly and easily during the restriction period. This means it's illiquid. There is a penalty placed on its price, but this represents the cost of holding temporarily illiquid assets versus fully liquid ones. Thus, my proposition is restricted stock studies are a quantification of a lack of liquidity, not a lack of marketability. Which method should we use? Well, there are many methods out there, many models. People use all different ones. Of course, I included the DLOL-M at the bottom. The most commonly used at this time are restricted study, stock study variants, option pricing model variants, and the QMDM. All have significant theoretical and practical negatives, which are discussed elsewhere, but not today. There's extensive discussion. I've done some of it myself, to be found. So here's a summary of propositions underlying our DLOL-M. First of all, the lack of marketability is a form of asset transaction risk, of which the DLOL-M is the risk premium. Second, when we go about doing this, we should ask our 5 questions and be open to new sources of data and information. And third, the restricted stock studies quantify a lack of liquidity, not a lack of marketability. So let's take a deeper look at the standard questions posed by Mandelbaum, because that's kind of our laundry list of what we use to think about the DLOM from a qualitative standpoint. Here's our Mandelbaum factors, the way we normally use them, and we're going to deconstruct these factors and sort them in 3 different ways. The first sort is security level risk factors. These are all familiar to you, and they're very commonly known, so I don't have to go through them, but they're at the security level. The second sort are factors that belong in the fundamental analysis. They don't belong in the DLOM. This is a nice place to use Monte Carlo simulation if you enjoy doing that, but these are things that should be moved out of Mandelbaum and put into the fundamental analysis. The third sort uses the IRS DLOM guidance, their guide, which is definitely old, but these are the factors that the IRS has provided for us. And many of them are applicable to publicly traded securities, but there are 4 others that are great guidance for company level factors for DLOM. So let's take these fundamental discussions and begin to build our DLOL-M. The first thing we're going to do is we're going to move into restricted stock studies and look at the liquidity component, the DLOL piece. So here's our typical table. We have many studies over many years, and I put it up here just to remind us of what we normally use. And as we stated, these studies are most appropriate as benchmarks for the DLOL. But which studies should we use? We have a whole lot of them. Well, there are 2 studies, I'll go back here, that are the longest studies, cover the longest period, and they end closest to contemporaneous to our current time. And those are the ones that appeal to me for use. However, you could choose others, or you could choose a mean or a median the way we normally do. For this exercise that I'm showing you, we chose to use the average for the 2 longest ones, which happens to be 15.85%. That's the DLOL. So now we'll work on the marketability risk component, the M. And I'll show you how we can map and build it. The first thing we would do in this particular technique is to select what I call target M. This is the baseline, which we will adjust to arrive at the final M that we use in our final risk premium. For this exercise, to be conservative, we estimated target M to be 10%. This comports with the marketability discount commonly used for the whole company. And in Pratt, he doesn't say you have to, but he says that some people do, and I've used it myself. I'm comfortable with the 10% for the length of time it takes to sell and the kinds of resources needed to sell the whole company. The second step will be to set up 2 ranking and 2 benchmarking exercises. 1 pair will be for company level factors and 1 pair for security level factors. So ranking and benchmarking are commonly used in qualitative analysis. There's a lot of literature on building these things. They've been used for years and years and years in all sectors of the business community for all sorts of things. And the following that I'm going to show you is just one set of suggestions. I tried to pick something as I was building this for myself that would be simple, that would be straightforward, that could be explained easily. Ranking is great for allowing us to present the findings from company and industry research and management interviews in the order of importance. So the work that we do to build our case for the rest of our analysis can actually be reutilized in this particular sense. And benchmarking allows us to place the subject within the context of selected peer groups. And we do that already again in our industry and competitive analysis. So we've been thinking about these things. We just haven't formalized them into a type of ranking or benchmarking exercise. We're going to start with company level analysis. This is going to reflect and investigate the attractiveness of the subject company and its industry. Two of the three risk factors that I mentioned, one market facing, one desirability. The goal is to create a marketability score for the company and use it to adjust M. This particular ranking exercise can either increase or decrease M. And counterintuitively, because M is negative, a positive score will decrease M and a negative score will increase M. So these are comments about our sample company. And we get 32 points out of 50 possible. And these are using informed professional judgment to select, knowing what we know about this particular company. They could be anything depending on what the company is like. Here is a benchmarking exercise. And what I've used to benchmark against is some M&A data that I gathered from, I believe, from a Big Four paper on this particular sector of the market. These are the market values of invested capital. This could be deal stats, but in this particular case, it was other data. And I've benchmarked it against industry attractiveness. So are companies in an industry, how attractive is that industry? By size and attractiveness, there are points assigned. And I've been asked, why do you assign these particular points? I do these particular points because to do it more detailed, if you did increments of 10 points, you make it very complex. If you do less than 20 points each, it becomes too simplified and there's not enough detail. This is a very simple level of detail that we can develop a ranking exercise from. And our particular company has market value of invested capital between 5 and 50 million, and it's attractive. And we can see that from the prior slide. So it gets a 160 point benchmarking rate. Now, how do we put this together? Well, we're going to get our score, our marketability score, by taking a percent of the points that were assigned to a particular company out of the total points. And we've done that in both of these places. And then we average them. And this percent marketability score is going to be something that will allow us to actually adjust the 10% M that we started with. So here are our potential score ranges. And here is the adjustment related to each score range. Now, how did I choose this? Well, I chose it because we really don't want to adjust the marketability discount by more than 60%. That's just a very high adjustment. So going down by increments this way allows us to refine how we're going to adjust it. The 72% marketability score fits here within the range next to the 80%, which relates to a 30% increase or decrease to target M. I hope you see where this is going. So the security level analysis is much the same, only we're focusing on something else. We're focusing on the ease of transferability of the subject ownership interest. And again, these are the two risk components that we talked about in this whole risk factor, the market-facing risk and a desirability risk. And again, our goal is to create a marketability score for the securities, which is representing the specific ownership interests, and then use it to adjust M. Right, so this is the ranking exercise, the +10 and the -10, the way we did before with the company, only we're using Mandelbaum factors for the securities. This is a benchmarking exercise. We take our SBBI deciles and we look at these in terms of desirability because that's an easy target for that. We know that, the ones are traded the most and they're considered the most desirable, and the 10th decile is traded very little and is considered not very desirable amongst all the publicly held stock. And then we benchmark that against our subject security desirability. And because of what we did in our last ranking exercise, it only got 40 points out of 70. We've decided that this company securities are somewhat undesirable because they're locked up in various kinds of ways. So we pick this for the 10th decile, and we come again to this chart that we used before, where we take a percent of the total points for ranking exercise and a percent for the benchmarking exercise. We blend them by averaging and get a marketability score. And that marketability score is plugged into the same chart as before, where we have a 59%, pretty much, oops, sorry, I'm going too fast here. The 59% fitting into the 60% category with a 30% adjustment to M. All right, how does this look when it's pulled together? This is the final buildup for the DLOLM. First, we have our DLOL at 15.85%. Then we have our target M at 10%. And then we have a decrease to target M, which will be positive, from our company level adjustments, and an increase to target M of 30% from our security level analysis. And when we sum that, we come to a DLOL M of 25.85%. Right? It's a very simple, it seems almost simple-minded, but it can be discussed easily, and the data is there to support these things. So let's talk about time period risk, because this is where it really gets interesting and kind of exciting. So when we use OPMs or QMDM, we actually have to select a holding period for the subject. OPMs typically don't go further than 5 years. The QMDM says pick, using your informed professional judgment, pick a holding period that seems to be reasonable. If we remember, the subject securities and restricted stock studies are held 2 years or less. So we have a fairly short holding period here for these. I'm going to propose that there are 2 pathways we can use the DLOL-M for. One of them is our traditional perpetuity. The other is an explicit holding period, and we should be able to choose between the two as opposed to having to go one direction or another. So let's look at what we do with pathway 1, which is our traditional perpetuity. In this, we do as usual. We develop our discounted net cash flow analysis and our other analyses with a perpetual terminal period for the DCF. Once we get done with an estimate of value, that from our different techniques, and we blend them or pick one, however we choose to do it. We apply our appropriate discount for lack of control, and then we apply the DLOL M the same way we'd normally do. So that's pretty simple and straightforward. For the explicit holding period, this is a little different. What we have here is we have two periods that we're going to look at. We have the forecast period and the holding period, and they're going to be valued a little differently for reasons that you'll see in the next slides. The first thing we do is we develop our DCF for the forecast period. And because both liquidity and marketability risk exist for that period, for the forecast period, we apply the full DLOL M to the sum of the year's discounted net cash flows. That's normal. I want to put in here, because there is a commutative property of multiplication that allows us to wait till the end to apply the DLOC. We don't have to apply it first. We can apply it at the end. So that's what we're going to do in this case. So the next thing we're going to do is we're going to look at the holding period, and we're going to talk to management and select a holding period that they think is reasonable. They think they're going to sell in 3 years or 5 years. 10 years is the outside for the holding, for an explicit holding period, because after that, it really becomes a perpetuity. So 10 years is our outside. And then we're going to have them help us select a growth rate for each year's cash flows in the holding period. It could be the same growth rate for each year, or it could be different growth rates for each year in the holding period. And so thanks to, and as with the QMDM, we then select and develop a holding period discount rate. So this may be different than the discount rate used for the forecast period. It could be the same. We'll talk to management and get their expectations for the holding period. We'll look at the forecast period discount rate, especially the one of the last year of the forecast period, and we will select one that we think fits, or several, depending on whether you want to pair off the discount rate over the holding period. And then what we'll do is we'll discount the cash flows in the holding period back to year 0 of the holding period. We do not discount them to year 0 of the valuation date yet, but only to the year 0 of the holding period. And there's a reason for that. Okay, so an explicit holding period resolves the issue of marketability, because if the subject interest is going to transact by the end of the holding period, it's basically marketable. But there's an issue of a penalty for liquidity risk during the holding period. So the only thing we're going to apply to the DLOL is the DLOL to the holding period discounted net cash flows. However, there's an interesting fact about liquidity. As we reach the end of the holding period, the liquidity risk has diminished over time, because by the expiration date of the holding period, the company or the securities are liquid as well as marketable. So the simplest way to represent this is to amortize the DLOL over the holding period. I used a straight line. It's very simplistic, but it's adequate, because what we're getting here is ranges. We're not getting precise points. Each year's discounted net cash flows will be adjusted by an increasingly diminished DLOL as we move to the end of the holding period. This can all be automated, and you can plug in things to a model. This doesn't have to be done customized each time, other than the decisions you make. So once you've done that, then you sum all your holding period discounted net cash flows and use that sum and discount that the way you would a perpetuity to year 0 at the valuation date. And what you've got is you've got holding period value plus forecast period value to have the adjusted value of the subject interest prior to applying your DLOC. So it's actually very, very straightforward. And it is more explainable. There are no black boxes here. don't have to make accommodations for things like volatility that can't really be explained or even benchmarked against anything. The idea here is to use something that has common sense to it, something that you can hang your hat on without feeling that you have to explain something so deeply theoretical that no one that's listening to you, that a judge or a lawyer or even your client will understand. So what problems have we resolved? Well, we've resolved the problem of definition. We've divided the DLOM into explicit liquidity and marketability risks, which we should have done before, and this allows us to actually do that. We've redefined both together as an asset transaction risk with the DLOM as the risk premium. So instead of looking at it as just an adjustment to value, it's a risk with a risk premium. We've resolved some data issues. We now can use restricted stock studies without having to fudge on what they really represent. We can take Mandelbaum and the IRS factors and we can sort them in a meaningful way instead of throwing everything but the kitchen sink into the list. And we have now company level and security level transaction risks, which is realistic. That's what actually is happening when you do the DLOM or when you do a DLOM. You're looking at both. We have methodological issues that we've solved. As I was stating earlier, we have a more defensible way to avoid leaps of faith and black boxes, which we've had to do a lot of dancing around as we use our different methods. But we also extend and refine the original insights of the QMDM, which is a very thoughtful approach to doing a DLOM. Only now we have 2 time periods to choose from. We're not stuck with either a perpetuity or an explicit holding period. So whatever best fits our company and our securities or our subject interest is what we can use. Each are handled differently and each handled elegantly. We make use of the science of and art of qualitative analysis, which is an authentic field with a great deal of writing and books and all sorts of stuff and teaching on, and we restore informed professional judgment to its rightful place, which again is my crusade, because I think that's what we're known for, is our informed professional judgment more than anything else. Anybody can crank numbers, not anybody can value a business. And there's some practical issues we resolve. For instance, we can repurpose our industry and company research, our management interviews, our competitive analysis. That's good. We've already done it. So we can create these things early on and use them for marketability scores. Ranking and benchmarking exercises can be developed, used, and defended very simply. Don't have to use the numeric content that I've presented. You can use your own, but the principle, the concept, and the layout, the process is pretty much what I've shown you, and it's something that can be used quite simply and codified in your models. Doesn't have to be recreated every single time. The entire process is transparent and it's accessible to people who are not professionals in valuation, finance, or economics, which is very helpful because it gets difficult to try to explain these things to clients or courts when, we are using a lot of finance language or the language of economics, which is impressive but not useful. And so we've come to the end of this presentation. I'm welcoming any questions that you all may have. I will state that I have used components of this myself for many years without being challenged. I have not used the whole enchilada because this is a pilot at this point.
Yeah, thank you. Thank you, Sarah, for your view on applying traditional data in a new look and in the new interpretation. We received some question. There was one question for page number 48 from Andrew. Page number 48.
No, I can find that too by going back.
Okay, 48, 48,
We'll
48,
look at that.
48. Okay,
All
okay.
right. So,
think Andrew.
yes.
And the question was, why is there equal weight to potential marketability and M?
Why is an equal weight here for
Yeah,
each of
yeah,
these? All right,
yeah.
this is a sample company. This is just an example of what one might do. A different company, I chose a company that was interesting, desirable. Its stock had some problems because they weren't it wasn't easily transferred. We assumed that this particular company were valuing a minority interest at some level, not 100% ownership or over 50% ownership interest. So this is just what some people call a toy example. It's not a real company. I actually have a whole example of a real company. If somebody would like me to send them that to show how it works for something other than this, but this is just a way of showing what it would look like. We could rank these transfers being limited by agreements out of 5 because the agreements are not draconian in the way they limit transfer. But I gave it a 10 because in this particular case, the only transfers permitted in the legal agreements are to shareholder trusts, family, and related party entities. So that gets a 10. That's the biggest adjustment downward or upward, whichever way you want to look at it, to the DLOM. It has to be increased for this factor. Does that help? I hope. It's an arbitrary choice on my part using informed professional judgment. And with the companies you work with, you will have something completely different.
Sarah, could you share the real example that you mentioned?
I can't hear because I didn't prepare
I mean, can you
slides.
send it out to the people?
I would be delighted to do that. Happy to
I
do
think
it.
others would be
So
interested as well.
certainly, no, and it looks better when you can see it start to finish. This is taking a segment and popping it in, and it looks very subjective. So when we're done, I will send it over to NACVA and they can distribute it.
Thank
Does
you.
that make sense?
Perfect. Yeah,
Okay.
perfect. Thank you. Thank you, Sarah. There was another question in the Q&A from Sergio Alvarez. How do you navigate the defensibility of a novel method under scrutiny, given that well-established methods are the ones considered trustworthy?
Well, let's start with the idea that our field is a dynamic field. We are not like the language of Latin that is now used universally, but no longer changes. We have new things coming along all the time, and we need to adjust what we do as we grow, as we change. One of the things that I've found very exciting was my participation in some international communities that are doing really, really fascinating work. Outside the US, it seems that we in the US get stuck and the international community is more inclined to think differently about lots of issues. We have to start thinking differently about standard practice because it's the only way that our profession will change. Now, looking back 30 or 40 years to the founding father, Shannon Pratt, that fellow challenged standard practice over and over again as he built what we now know as standard practice. He would go into court and he had a good defense for his new thought. He would even correct himself without feeling the slightest bit of trepidation. If he changed his mind about how he treated something and he went into court another time, he would tell the judge he changed his mind. I think we need to have the boldness to use the intellect that we have because there's a tremendous amount of intellect in our profession. And to defend what we've done carefully and well, to tell a good story, but not be afraid to say, this is the new story I would like to present to you. This is the way this works. I think this works well because of X, Y, and Z. It sidesteps these problems, and here's the way it works. It's the only way that we can introduce new things. And this has been true in the history of human beings. Every time something new comes up, whether it's science, the arts, if you all know anything about the arts, you know that when the Impressionists started painting, they were considered outrageous. And they were completely rejected by the standard practice painters of the day. And they were not even allowed into the salons because they were considered sloppy and this and that. And yet we love impressionistic painting. So I think we need to allow ourselves to have a broader, more expansive view of what we're doing, and then defend it carefully and well with a good story. We do that anyway when we go into court with, our particular stories within standard practice. We have to defend what we've decided to do with the company. And sometimes we take an avenue that isn't, what somebody else would choose to do. So I don't know. I think free thought still needs to exist in our profession. And that's the only answer I can give.
Yeah.
Don't let free thought be something that's completely outrageous. You don't want to, you don't want to lack rigor, but if you have a rigorous, adequate way of supporting what you've done, think freely, for heaven's sakes.
Sarah,
Yeah.
may I suggest to you that, by the way, your presentation was excellent. It provides structure, but ultimately it's still arbitrary and incorrigible.
Absolutely. But
And I
all of
think
what
that's
we do
and I think
is
that's important to note, and also probably that should be part of the preamble when using any such approach.
when using, but we would say that if I had the time to take you through the option pricing models and show you how completely arbitrary and incorrigible our use of those are, and why we should never touch them because we're actually completely ignoring the theoretical underpinnings of those models, I think you would see that what we do in large part is we break a lot of rules in order to present a story properly that gives the right view. This is not science that we're doing here. This uses a baseline of scientific ideas, but we basically, we're artists, we're craftsmen, we add our touches, we look at things differently from each other. I mean, that's one reason why I love this field and fell in love with it all those years ago. It was my best Christmas present ever because I fell into valuation, not knowing what I was getting into. And I met people who think differently from each other and were happy to do it and argue to the hilt and then go out for a beer afterwards. It was very refreshing. This is not accounting where everything is specified by law and by rules. This is This is a hybrid of many fields and allows for creativity and flexibility. And I know that sounds wishy-washy and subjective, but a lot of statistics is subjective. You have to pick your population. You have to pick the statistical methodology you wish to use to explore your population. People can actually skew results statistically by picking and choosing what they want to look at and not telling anybody that they picked and choose. You know, there's a lot of subjectivity in all the work we do. We just don't talk about it because people want to look like scientists when actually we're artists with a scientific baseline. That's not a good answer, I know, but it is the
Well,
answer that we
no,
need to look at in order
actually,
for us to
actually,
grow.
actually, it is a good answer because I know when I've gone to court in the past, there have been situations where I differentiate between a CPA for who 1 + 1 is always 1, but for evaluator, forensic accountant, 1 + 1 could be 3.
It could be.
And it's
It could
how
be
you
3
can
or
present
300.
why it may be 3 rather than 2.
That's right. I agree.
And that's what
And I
this field
think
is
that
about.
it is indeed what this field is about. And I feel that it's a shame. A lot of our younger people have gotten encouraged to do sort of a plug and play approach to the work. And it is a disservice to them and to their intellects
Maybe
to
so, but a
have
lot of the
an,
younger people are quite superlative in what they do.
there are some that are quite superlative, no doubt. And we were some of those people back in the day too. So we people looked at us and said, "Oh my goodness, look at what that person is doing." Any other
Yeah,
questions?
yeah. There's one final question from Akil Ekö, but I would guess that you have already answered them, but I will read them. Sarah, do you think the BV industry needs an overhaul of the theoretical framework and practical use of the way DLOM or DLOL are taught? I would guess your answer is yes.
Yeah.
My answer is yes. My answer is yes.
Yeah, and
But that's
I
not bad. That's not bad. That's good. That's helpful. And if you do an overhaul and you examine something from the bottom up and you look at all the aspects of it and you come away thinking, gosh, we did a really good job of that. Let's leave it alone. Then you've also accomplished something because you haven't just accepted it because it's there. You've accepted it because you actually believe that it's the best way of approaching the problem. And to
yeah.
me, that's part of being a master at what you do, you know.
Yeah, and thank you, Sarah, for these thoughts. And I can say from you touched the international field, and we are based in Germany, and I know a little bit about the European view on business valuation, and we also like to hide behind formulas and data. So this is, I think that's quite similar compared to the US, and we at the very end we must be brave enough to take sometimes to take different paths, to take different argumentation, um, to tell maybe a different story than 15 years ago.
I think
Wolfgang,
so.
Wolfgang,
Yeah,
another consideration is that in terms of what Sarah presented as one avenue, if you can take multiple approaches and there's a convergence in terms of the outcome, that only strengthens a
sure.
practitioner's presentation.
It's
Definitely,
true.
definitely.
Yeah.
And what I've learned also is that judges sometimes they are much more familiar with professional judgment at the very end than with formulas and volatility and all these numbers. So
And they're not uncomfortable with it,
yeah, they are comfortable with that.
assuming
Exactly.
that it's well supported and the story makes sense and
Yeah.
that there's common sense to it. If there's no common sense to it and it's a black box,
Yeah.
that's not something they like very much.
Yeah, the plausible story is much more valuable and worthful than
And it has to be
an
simple.
exact number. Yeah, it has to be
It has
simple.
to be simple.
Yeah.
It's the KISS approach works.
Yeah, definitely.
It does.
So
It does.
thank you, Sarah, for your brilliant thoughts. I think
Sarah,
that's a
thank
good
you. It was excellent.
Well,
good entry
good.
in
I'm glad you
the
enjoyed
Christmas
it.
time. Okay.
Yes, it is Christmas.
I
It is
think I would have
Christmas.
enjoyed it over a beer more.
Oh, yes. Well, and at the beach location behind you, right?
Beach
I'm sitting in an office location.
or with Wolfgang in Germany.
There you go. That would be nice. We'll have to do that. We'll have Christmas in Germany. That would be very nice. I gather it's a beautiful occasion in Germany.
Definitely for Christmas is the Christkindl market in Nuremberg, for example, or other cities. That's a nice place,
I'm
definitely.
sure. I'm
So
sure I've
thanks
seen
to
pictures. I'd love to be there. Well, thank you very much.
Thanks
all of
to
you.
everybody.
Wish everybody a happy holiday and peace.
Yeah, happy
I
holiday,
will.
peaceful Christmas time, and see you on January 26th.
Good New Year.
In the
Good New
new
Year.
year.
And yeah, great to have you here today. So thank you.
All
Thanks
right.
to all.
Thank you.